CPI tomorrow, PPI on Thursday. Higher inflation typically seen as favoring value stocks, which have outperformed this year. But my next guest says it's time to rotate into quality growth, which does best when earnings, inflation, and the economy, broader economic growth, are all falling. Let's bring in Jeff Mills, Bryn Mawr Trust CIO and a CNBC contributor. Did I capture that correctly, Jeff?
Yeah, I think that's about right, Kelly. And look, generally speaking, I feel like the rally is fading. But if you have to be long like we do, you have to pick your poison. And I think the big theme going into the second half of the year is going to be this rotation from value into growth. And it's not growth all across the board. It's not the junk stuff, but it is more of the quality growth. And, like you said, whether it's Amazon, whether it's Google, it's these stocks that are priced well and have some semblance of earnings stability. When inflation is high and falling, that's when growth tends to do well. When the economy is slowing down, when earnings are coming down, investors are going to look for earnings growth where they can find it. And I think it will be in a lot of these quality growth names. So, whether it's the NASDAQ now failing at the downward sloping 50-day, whether it's the 210 spread now starting to invert more than it's inverted the entire year.
Right.
These are things that are telling me that earnings expectations need to come down. And that's why I think you need to favor companies that can continue to grow earnings. And
you're the third person today to tell us you like Amazon, so I'll just make note of that. Google as well is another quality growth name that often comes up. So let's talk about Danaher and Jacobs Engineering, even United Health. How do those fall into a quality growth bucket for you?
Yeah, I think when you think about names that are growth at a reasonable price, Danaher is a really interesting name. And just from a chart perspective, finding support around that $250 level, I think that's noteworthy. Obviously, 30% off its highs, like a lot of these names. This is a company that makes equipment for drug development, disease testing. So it's tied to biotech spending, which I think is a very good thing long term, whether it's gene therapy, vaccines, molecular medicine in general. But it's certainly a less speculative play on biotech. And what the company has is a very large install base for their equipment. And then they're able to sell this high margin consumables. And that's what really drives their revenue. That's 75% actually of their sales. So the key for that company is great management to navigate this environment and recurring revenues because of what I just described.
And a word quickly on, when we talk mega cap tech, does pretty much all of that fall into quality growth or no?
Yeah, I think, most of it does. I think you're starting to see some shifts now. Is Apple value? Is Apple growth? What about Netflix? What about Facebook? But I think generally speaking, when we're talking about the old FANG complex that we all think of, those are the companies that have, high return on invested capital, high free cash flow, solid margins. So generally speaking, those are the companies that you're going to want to favor in this environment. And like you said, specifically Amazon, Google, these are stocks that have really attractive valuations, really high profitability, and have got beaten up to the point where I think, if you can weather some near-term volatility, you're going to do really well.
All right, you can see them chopping around here the past couple months trying to find that bottom. Jeff, thanks for your time today. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.